Hello and welcome to our Forex training course. And today we are going to look at the Forex terminologies. Under the Forex terminologies, we have these terms like going long or going short. So when we say going long, is that you are expecting for the market to continue gaining value. Or it is a process where you are executing a buy order after a currency has been losing value for some time, and from your analysis or from your speculation, you are expecting the currency to go up to gain value. That is when now you will be going long. And when you say going long, it's just the other term of say you are buying the market. You see? And when you buy, you are anticipating for a bullish movement or an upward movement in your chart. There's also going short. There's going short. And the going short means executing a sell order. And when you are executing a sell order is when you are expecting the currency pair to lose value compared to the counter pair. So you are expecting the currency pair to lose value is when you will be now expecting to see your chart going in a downward direction. So when the market will be going in a downward direction, this is when now you will be selling your position. So you will be selling and anticipating for the market to continue going down. So we are going to look at these two types of markets, that is going long and going short. So we are going to look at the going long, and you have said going long is also the same as buying the market, buying the market. So we will be buying when we expect the market to gain value. So let's assume this was our chart. The market was going down this direction, has been losing value like this. Let's talk about a commodity like tea, for example. You can even talk about tea. Tea has been losing value for some time. That's an assumption. So let's say tea has been losing value for some time. And now it has reached a point where we are seeing there is a lot of resistance from this pair from going further down. Meaning this pair now is starting to get resisted from going below that price. And now the volume that is being building up is the volume to go up. So when you are expecting this market to go up, you will be buying at this place. This place where your orders will be sitting. This is where your buy orders will be sitting. And now you will be buying from this area here, and you are expecting the price to continue going up. You see? So you'll be expecting now this pair to gain value from this place there to the top part. Let's say this place is $1.0, and the top, the highest that you are expecting is $10. You see? So if the pair is at $1, and from your speculation, you are seeing this pair is going to go up, so you will be buying here. You'll be buying at this low, and you want now to see that pair gaining value. Going up, up. So this movement, this upward movement is called an uptrend. Or at times, some people call it bullish movement. We are still going to learn about what is bullish, what is bearish. Yes. So this movement is when we are expecting a pair to gain value. Now let's look at this another scenario. Let's assume this is something like euro. Let's assume this is euro. Let's assume this is euro USD. And this euro USD has been gaining value from this low here. Has been gaining value from this low here. Has been gaining value up to this far here. Now, when you have seen from your analysis, you have been following this pair, and you have seen now this pair has reached a point where it is no longer going up. So what comes in your mind is that this pair is likely to be losing value in the near future. And now what will you be doing? You'll be selling at this point here. At this place is where your sell order will be sitting. So you'll be selling at that point, and you are expecting this pair to continue going down from where you have just sold. You are expecting this pair to continue going down for you to earn profits. So if the pair was at, let's say $1.1900, $1.1900. So, and this is euro against the USD. And now you have seen US dollar is becoming strong and euro is becoming weaker. That's it. So if you have seen now euro is becoming weaker and US dollar is becoming strong, it will be forcing the euro to lose value, because the euro will be losing value and the USD will be gaining value. So if the euro will be losing value, it means what? You are going to be selling at this point here, and you expect this pair to continue going down from where you have sold up to a certain place like this place here. So this is a place where you are going to be now taking your profits. You see? Yes. So let's go to the real, we can go to the real chart. We see whatever we are trying to talk about. So we have this chart here. We have this chart. Just a minute. I don't know why now. So we have this chart here, the euro dollar. And now the euro dollar, from the place that it has been, we can see from this place here until we go to this lowest point here. This pair has been losing value. It was at 1.16901, and it has gone down to this low 1.12. So there are factors that may make this pair to go down. We are still going to learn more about these charts, the candlesticks and the stuff. But the first thing that we want to know is how are we going to place our sell orders? How are we going to place our buy orders? And when we say we are selling, what do we really mean? When we say we are buying, what do we really mean? So if, like for instance, this pair, it was rallying up to that far. So at this point here, you could have bought. At this point here, you could have bought this pair. At this place here, you could have bought this pair. You could have just bought that pair and take your profit at this point high and take your profit at this place. So that top part should be where we are taking our profits. And now when we have seen this kind of a consolidation, we'll be likely to be seeing what is wrong with this pair. Why is this pair consolidating? That is when now we'll be going to see how is the economy of the euro, how is the economy of the dollar. If the economy of the dollar is strong and the economy of the euro is not behaving very well, the dollar will be very strong compared to the euro. Meaning what will happen? The value of the euro at that time will drop, so that you will be exchanging a euro with a lower price compared to this place. You see? Because of what? The dollar will become now, the dollar will become strong, will be becoming strong. You will not be requiring too much amount of dollars to buy 1 euro. So if that will be the case, then you will be expecting, or you will be speculating to see the price doing what? To see the price going down. So you'll be expecting to see the price from this place here going down. So you'll want to see this pair going down from this high here, and you will want to see that pair going down. You see? So here is where you'll be placing your sell orders. So this place where you'll be selling that trade. So that area is where you'll be now selling that trade. You'll be looking for the opportunities to sell that pair at that time. Okay, so we want to look at, let's look at some place here. Let's talk about this place here. This place here. This is not the strategy that we are talking about. We're just trying to see where we could be able to be buying and selling the pairs. So like for this place here, this could have been a good place for us to buy and take our profit here or there. This place also could have been the best place for us to buy and take our profits either above this high or even above that high. You see, and now when we'll be expecting to see this pair losing value, like this place here, you can see these tops are almost equal. So we'll be expecting to see the market going down here and it will be selling at this place. We'll be placing our sell orders here. So that is now the going long and going short. So going long is when you want to see the market going on a bullish direction, and going short is when you want to see the market going on a bearish direction or a downward movement. Yes. Okay. Let's look at the bullish, bearish, and ranging stroke consolidating markets. So these are the type of markets that you'll be finding in the Forex market. You'll be having the bullish market, the bearish market, and the ranging market or the consolidating market. So what do these mean? So when we say a bullish market is a market that is going on an upward direction, or it is a market that is going on a on an upward movement. That pair is making a series of higher highs. It's coming from this high, going to the next high. Coming from that high, going to the next high. So you see, this market is going higher, 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 higher. You see? So this movement now will be called a bullish movement. The market is going upward like that. So this is a bullish movement. And now when the market is not moving anywhere, it is just stagnating. It is just staying. It is not moving up. It is not moving down. It is just staying there like this. Let me just do a candle like this. Let's assume the market is not moving up. It is not moving down. It's just staying there. In a car too, just assume the market is staying like that. So this market here is consolidating. This market here is consolidating. It's just making a series of candles here, making a series of candles. Say you can say the candle, the first one, that one, then it reached that top, the next candle, then it reached this low, the next candle, it came to this low, the next candle. So this one will be termed as consolidation or a ranging market. And when we say a ranging market, is a market that is neither moving up nor moving down. So the first one that we have seen is a bullish market. And the next one that we are seeing right now is a consolidating market. Is a consolidating market. You see? And now, if the next movement, the market comes down, make this series of lows. From this low, it gave us another low. From that low, it gave us another low. From this low, it gave us another low. This one will be called a bearish market. A bearish market. And when we say a bearish market, it is a market that is going now on a downward direction. Downward direction. And these terms, bullish and the bearish, was just determined from real life situations where the bull, when the bull is hitting you, it will not be hitting you to go to the down. The bull will be trying to push you to go up. The bull will be knocking you to go up. While for the pair, the bearish now itself, the bear When it is knocking you, it will be knocking you to the ground. And that's why the market is called, when the market is going up, it is the bullish, the bulls. And when the market is going down, it is called the bears. So when the market is going up, the market is shooting, or it is pushing you to the upper side. And when we say bearish, is when the market is pushing you to the lower side, or when the market is going to the lower direction. And the consolidation is when there is no activity, the market is just moving sideways. It just moves the top part, comes down, moves the top part again, comes down. So that is what is called the bullish and the bears, the bulls and the bears, the bulls and the bears. So we are going to see this in the live charts here. Now we're going to see that one in this live chat, this place here. So let's go to this. Let's go to the previous activity that has been going on. If there's nothing, we can just look at this and at this place. So here, let's see here. Here, this market was going down. I'll use this brush here. So here, from this part here up to this low here, this market was going bearish. This market was going bearish with a little bullish movement in here, with a little bullish movement and a bearish movement to this low. And also when that market was done with the bearish movement, it had a small bullish movement. It had this small bullish movement from this place here to this place here. Once the market reached that place, it consolidated for some part of the time here. It did a consolidation here. You see, that was neither moving up nor down. It was just playing around that area. So this one now is called consolidation. Then after that consolidation, the market made this small bearish movement and also made this bullish movement. Then it turned and made this bearish movement. After making this bearish movement, the market moved up, made to us a bullish movement. Now let's look at the classical where the place where the market was consolidating is around. So we can consider this whole region as a consolidation from this high here to this low here. As much as the activity is there, but that activity is very small. It's very small. So see, the market is just playing around this place. So when the market is playing around that area, it is just called consolidation. No peak activity going on. The market is just playing around. The market is just playing around. And when the market is playing around, we call it consolidation. Look even at this high here, this place here. You can see the market was not moving up nor down. It was just playing around. Look, it was just playing around that area. So the market just was doing consolidation here. The market was doing consolidation. Then after that consolidation, the market made this bearish move to this low. Then after making that bearish move to that low, it consolidated. It did a consolidation for how many days? 1, 2, 3. How did I determine these are days? You see this line here? This line separates the previous day from this day and from the next day. So these dotted lines are the ones that separates the day, and they are called period separators. We are going to learn how to place these lines on your chart, even how to make up your chart to be like mine. So we are going to learn about that one. So you can see this market here was consolidating. Then after that consolidation, the market made a bearish move to this place here, and then made a small bullish move, and then reaching here, it consolidated for some short time period. Then after that consolidation, made this short movement here and also consolidated here. And after that consolidation, the market also made this bearish move and consolidated here, made this small bearish move here, and it retraced back here and made this consolidation here. And then after that consolidation, the market did what? It made a bullish move to the high. It made a bullish move to the high. Then after that is bullish move, the market did a small consolidation here. The market did a small consolidation here, then made this bearish movement, did another consolidation, and made this bearish movement. After the bearish movement, it made also a bullish movement to this high. Then after that bullish movement to that high, sorry, a minute. Sorry, don't worry about that. So it came to this high here and made this bearish move. Then after that bearish move, there was this consolidation, a small bearish move, consolidation, even to this place, just consolidation. Then after this consolidation, the market did a bearish move from this high to this low, and reaching this low here, it did a consolidation. So after the consolidation, the market also made a bullish move here, and a bearish move to this low, a small bullish move here, and a bearish move to this place here, and the market did a consolidation, then a small bearish move and a retracement to that high, and the market also did a bearish move. After that bearish move was made, the market reached this low, and also it did a small consolidation before this bullish move. Then the market that made this bullish move to this high, it also went down and consolidated here. After that consolidation, the market moved bullish from this low here to that high. So we can just consider the whole of this a bullish move. Then from reaching that high, the market came down. So this is a bullish move and this is a bearish move. The market came down to this bearish move here, and reaching this place here, there was small bullish movement, small bearish movement, and a consolidation. Then we had a bullish move to this high, a small bearish move, and a bullish move, a sharp bearish move to this low, a sharp bearish move to that low, and then we had a strong bullish move to this high. So you see, that is now how to mark the bullish moves and the consolidation. You can see the market consolidated, made a bearish move, consolidated, bearish move, a small bullish movement, consolidation, bearish movement, like that, like that. So we are going to still learn, explore more, and going to still learn a lot. Okay. Let me take you back to our notes. So also there is a swap. There is this term called swap. And a swap is the broker will charge you for holding the trade from a certain day to the next day. So if your trade stays in the market until the next day, the broker will be charging you something called swap. And this swap is the money where the broker will be making some profits from trades. If you have traded, you have seen a pair, it's going to move bearish for 2 weeks, and you don't want to close that trade every day. You can hold your trade to run for 2 weeks. But now remember, inside here, when your trade will be running, you will also be charged swap. But also remember, these swap are not very much expensive, something like $2, at times $1, at times 0. It depends on the market that you are in, and also the broker that you are using. Some brokers charge a lot of money to hold that trade open to the next day. Some other brokers don't charge a lot. So there's also a term called equity. And when we talk about equity, is the actual funds available for you to trade. So when we talk about equity, these are just the funds that is available for you to do trading. So there's also this term called spread. And we were saying the spread is the difference between the ask price, that is the selling price, and the bid price, which is the buying price. And always when you are in a business, if you are buying something, you will buy that something at a low price and go and sell it at a higher price. That is what these brokers does. They buy for currencies from us at a lower price and they sell to us at the higher prices. Also, remember this difference in price, which is called spread. This spread is the money where these brokers earn as commissions. And also you have to remember one thing in mind. If your broker is giving you a very high spread, if your broker is giving a very high spread, it means what? It will take a lot of time for your trade to make profit, because first of all, you'll be paying the spread, and then after paying the spread, that is when you come to become profitable. Meaning if your broker is charging you 4 pips, you are going to learn about pips. If your broker is charging you something like 4 pips, it will take you, you will have to pay the 4 pips first of all for you to make profit. So let's say if your target was 6 pips, and here your broker is charging you 4 pips, you see you will be making a lot of money to your broker compared to making a lot of money to yourself. But it depends. Not all the brokers are bad. Some brokers are good. We are going to look at them in the due time. So there is something called, sorry, I jumped a little, sorry. So there's something also called leverage. And the leverage is a tool that will allow us to increase our market exposure. Remember, with your $100, you cannot be able to trade in Forex without using leverage. Why do we say you cannot be able to trade in Forex without using leverage? This is because the money that is required for you to participate in that single trade is more money. And meaning you going there with your $100 without a leverage, your $100 may be just swept away easily. You see? But now with leverage, your money will be multiplied by a certain ratio that you selected to create your account with. You see? So if your account is $1,000, or if the balance that you have in your account is $1,000, and you are using a leverage of 1:10, or even 1:20, or 1:50, or 1:100. So if you are using a leverage of 1:100, it means you'll be able to get a higher market exposure compared to the person that is using 1:1. You see? Because that person using 1:1 will be looking for, his market exposure will be very, very minimal. And even he will not be able, some trades will refuse to take his order. You see? So let me just draw an illustration of leverage here. Let me just draw that illustration. Let's say this is a load that we are supposed to push it to go to some place, and this is you here. This is you. Let's say that person is you, although you don't look like the one. Just making an example here. Let's say this is you here, and you want to push this load here, this very big load. So for you to push this load, you will need to use something that is going to enable you to be able to push this big load. So what is that broker you are going to use? You are going to use a lever. So you are going to insert your lever here, and it comes to where your hand will be, and that is your hand here. So when you pull this lever, you see it will be very easy to push this load to go forward. And like when you were just pushing with manually with your hands. You see, when you are using the lever, it will be much easier for this load to move forward. Now, if you are doing that, it means you are making this work easier. So it is the same way as in Forex. This market needs a lot of funds. This market needs a lot of funds for you to trade, but you don't have those funds. But you want to be in this market. This is the market. And this is you here. Let me just write why. This is you here. So you will not be able to move to participate in this market if your capital is very small like that. So what do you need to do with this your capital? You need to magnify this your capital to be big using borrowed capital. And this borrowed capital, you can never withdraw to your account. You can never even see it in the balance of your account, but it will be helping you greatly to get market exposure. And also remember, leverage can be a good friend or leverage can be a bad friend. Why? This is because if your leverage is high and you lose, you are going to lose more of your capital because the exposure has been increased. So you are going to lose much of your capital if you lose. But also if you win, you are going to make a bigger fortune if you win because your exposure was very high. So it is a double-edged sword. If you use it correctly, it can help you. And if you use it badly or misuse it, it can also damage you. Okay. Let's go back. So that is it for the leverage. There is also something called margin. And when you talk about the margin, is the amount required for you to hold the trade open. Let's say if your account is $100 and this $100 you have traded and there's a trade currently running that is negative $20. So you can see from your account balance or from the running equity balance, it's like you're remaining with $80. But now this margin is the amount that has been set aside by the algorithms systems used to determine they are going to use this particular of amount depending with the leverage that your account is leveraged with. You see? So the margin is the amount required to hold the trade open. Okay. And when you are out of margin, it's like when you are out of your money. When you are out of your money is when now we can talk about the margin. So when we want to look at the free margin, and when we talk about the free margin, these are the funds in your account that are not currently in use. So if let's say if your capital was $100, if your capital at first was $100, and you are supposed to, for the margin for that trade is supposed to be something like $5. So when we talk about the free margin now, is the money that are not in use. Because now we have said free margin is the amount required to hold the trade open. And your balance or your equity was $100. So you will say now, for us to get a free margin, you will say now the equity minus the margin for us to get what? A free margin. So we are going for this example here, we will say now 100 minus 35 is supposed to be what? 65. So this is now the free margin. 65 will be our free margin. So there's also something called the marginal call or margin call. And the margin call occurs when you are about to lose all of your capital. So your broker will be notifying you that, hey, you are in danger of losing all your capital. The broker will be notifying you, hey, you have lost 70% of your capital and the remaining percentage is 30%. Do you wish to close your trades or do you want to continue letting those trades open? Some brokers, they may keep silent with the margin call. They may not notify you about the margin call. So it depends on the broker that you are dealing with. Because some brokers will be notifying you when your account is at 30%, is at a loss of 70%, 80%, and even some brokers may forcibly close your orders. May forcibly close some of your orders. If that broker is a good one, they will close your orders. Now there's something called pips. Pips. And pips is called point in percentage. And when we talk about the point in percentage is that we want to, when we do our calculation, we want to avoid a lot of 0.00001, something like this. We want to avoid this confusion here with the zero. So what will we do? We will employ the use of pips. We will employ the use of pips. And when we say these pips, this is the smallest unit in which a currency pair can change. So the smallest unit a currency pair can change. The smallest pair, the smallest unit in which a currency pair can change. And these changes depends on the currency that you are dealing with. If you are dealing with something like euro, if you are dealing with something like euro USD, if you are dealing with euro USD, it will mean, let's say the buying price and the selling price. Let's say the buying price, the price that you are buying at, buying price is something like 1.1819, and the selling price, we are assuming you are just a broker, and the selling price that you are selling this pair is 1.1905. Let's say 1.1905. So when you do this subtraction manually, it will be like 1.1905 minus minus 1.1819. So when you subtract, when you do the subtraction, when you do your subtraction from this place here, when you do your subtraction, let me just use a very nice one. Let me just take you to a clean board. Let me take you to a clean board. Let's talk about this place here. If we have euro USD, you are a dealer and you are buying euro USD, but you are buying euro at 1.1819, and you are selling the same euro at 1.1, let's say 945 or 35, something like that. So you want to find the difference, or somebody who want to come and buy your product want to find the difference. What is the difference? So you will come and say, now the selling price, let's say we are just calculating the spread for this. We want to calculate the spread, the difference between the buying price and the selling price. So the spread of to 1.1935 now minus 1.1819. So when you do this subtraction, let me just do it like that so that it can look better. So let's say you are coming now to do this subtraction. Let's say this place here. So when you have subtracted here, when you have subtracted this, when you subtract, say, this will be 2, and you carry 1 there, 10 there, that is 15 minus 9. So this gives us something like 6. Then this one will give us 1, and this one will give us 1, and this one will give us 0.0. So you can see these maths don't make, they are not really represented very well. So what do we do? Now what we will do, we want now to avoid using this 0.01116. We want just to use pips. So pips is just point in percentage. So like for this pair, this currency, like the Euro USD, it is its value is 1 all over 10,000. 1 all over 10,000. So when you do this 1 all over 10,000, with this one, this 1 all over 10,000 with this one, it's like now you're coming and this is 1 all over 10,000. 1, 2, yeah, 1 over 10,000. So the simplest way that you can do with this one is that you will use this format. You'll divide this one. You divide this one by 10,000. This by 10,000. So when you divide, you see it will eliminate the 4 decimal places. It will eliminate the 4 decimal places. But there is a shortcut that I always like to use. There's this simple shortcut that I always like. I always love using it. Let's say if our pair was 1.1935, and the other one was 1.1834, like that. So here, let me increase the size. To increase this size, or no problem, it can stay like that. So the way I always do is that I will not count this first number here. I will put this aside and now start counting 1, 2, 3, 4, and these will make pips for me. So my pips will start from this place here. So if I subtract this one like this, 5 minus 4 is 1, 3 minus 3 is 0, 9 minus 8 is 1. So I will not be using any decimal place here. So my pips here will be 101 pips. 101 pips. So that is what my pips will be. My pips will be 101 pips. So I'm going to take you right to the charts, to different charts. And we are going to see the change in the number of pips with those charts. So what I'm going to do, I'm just going to use straight lines from this place to the next place, and we are going to do together the change. We will be doing to see now the number of pips that pair is changing or is occurring in that pair. So let's look at it from this place here. So I'm just going to use a line here, this line here, let's say from that high and to this low here. Let's even say this low here. So there's these two prices, 1.13332, and we have 1.12791. So we have those areas. That area is 1.13332, and the next one is 1.12791. 1.12791. So we want to do the difference from this place here up to this place here. We want to see how many number of pips did this pair move from this high to this low. If we could sell, if we could place our sell order here, how many number of pips could this pair have moved? How many number of pips could this pair have moved if we could sell from this high here up to this low? So let's do it. So first of all, we want to determine this, like for this pair, it has 1 here. So we'll just, this first number we will assume not counted, the first number will not count. So there's X, and then now we start counting from here. 1, 2, 3, 4. So our pips will start from here and go forward. So the other remaining parts will be called pipettes, but we are going to learn about it in a few. So we want to look at it now from pips. So when we do this maths here, we say 3 minus 9 is 4, and 2 minus 7 is 5. That is now 12 minus 8 is 5. And here it is 0 because we borrowed 1 from here to go there. So it is 0. So our pips here is 54 pips. Let's use this ruler that they have given us. We can use this ruler to confirm our working, this one. So we are going to place our ruler from here up to this place here. And you can see here, it has written to us what? How many pips? 54.1 pips. So that is now the change from this high to this low. This pair moved from this high here up to this low here. And it has made how many pips? 54.1 pips to the downside, meaning you are going what? Short. I hope we are together up to this far. So that is now for pips. I want to look at another type of currency. We are going to look at another type of currency. Sorry for my internet, it is not very fast today. I don't know why. Let's look at the pair that USD Japanese yen. That is different from the one that we have seen that starts from 1.1. We want to look at another pair that even starts from 100 point something. So USD Japanese yen. I don't know why it is slowing. So USD Japanese yen, USD JPY, USD Japanese yen. I want to see that pair. How is that pair behaving? Sorry, because my internet may not be very fast, but I will try to see what is the problem with it. So, so here, let's look at this pair. This pair was moving from this high here, and it moved to this low here. As well say this low here. This pair moved from this high here to this low here. So we want to see the changes from this high to this low here. So I'm just going to use my text here. So let's say the point where this pair reached was 113.608, 113.608, and it moved down to 112.800. So this pair moved from 113.608 to 112.800. Now we want to see what was the change in pips from this pair moving from this high to this low when you did a short or when you are going short in this pair. So we are going to do the minus here, less here, we're going to less. And when we less, we want to see the change. So remember what I told you. Remember what I just told you. So if you are going to determine the number of pips for this pair, like for this one, you are going to assume the first pair, the first number, sorry. So you can put an X there on top of it. And then now you start counting 1, 2, 3, 4. And your pips will start from here. So your pips will start from there and to go forward. The numbers that are below here will be now represented as pipettes. So they'll be represented as pipettes, but I don't want to look at pipette right now. I want to just see on pips. So let's do our subtraction here. So we'll subtract 0 minus 0 is 0. 6 minus 8, we have to borrow this and it gives us 16. So we will say 16 minus 8 is 8. So now here we will have what? 80 pips. 80 pips. Or you can say, if we will add this one, the pipette here, that is on the other side, this is 8 minus 0, which is 8. So we'll say 80.8 pips. 80.8 pips. 80.8 pips. Let's use the ruler that has been provided. by the trading view and to see if we are correct. So from that point here up to this low here, how many pips are something we are, don't worry about the change, a small fraction, probably my ruler has not gotten it very okay. From that place, 1 point, let me assume it is correct right now. So from that place to this place here, around 80 point something. Yeah, none of there's a small place that we did not cover very well. Let me just still repeat. I want to be very, very accurate in this. Like from that place there up to this place here. Very correct right now. So you can see it is 80.8 pips. That pair has moved from this high to this low. So I hope you are understanding how to do the subtraction. Let's look at another example here. Bitcoin. Bitcoin, that is BTC USD. BTC USD. I want to look at the BTC USD because also BTC USD has a very huge figure or has a very huge number. And today, BTC has been going down. It has been going down. And I'm still expecting even this Bitcoin to continue going down. This was my expectation. You can see this line that I've drawn. I'm expecting this Bitcoin to come to this low here, 39 something, 39.58. No problem. So we are seeing here. We want to see the change. Let's say even from here. Currently where this market has moved. It has moved from this low here to this high here. It has moved from that low to this high here. Let me remove this line. So let's say even up to this place here. This pair has moved from down here. Let me even use here what has just happened currently in the last 1 hour. This pair has moved from here to this place here. So we want to see how many number of pips has this pair moved in the last 1 hour. So now let's come here. So no problem, this is the whole of it from this line here to this line here. So our pair has moved. It was done at 47,339.95 and it went high to 47,886. It went high to 47,886.73. So we are going to less this max, the opposite direction now, that is 47,886.73 minus 47,339.95. When we less, what do we see? That's when before we do the subtraction, first of all, we have to determine the number of pips, and we will now neglect we will not count this first number here, and now we start counting from here. 1, 2, 3, 4. So anything beyond these 4 numbers is now pipettes. Anything above these 4 numbers is pipettes. So now let's start subtraction. When we can start from these ones that are here. So we'll say 7, we borrow 1 here, that give us 13. 13 minus 8 will be 8. 13 minus 5 will be 8. And now 9 minus 16 will be 7. And then 9 minus 15 will be 6. And 7 minus 3 will be 4. 8 minus 3 will be 5. And 7 minus 7 will be 0. So for this pair, it has moved from this low here to this high, 546.78 pips. This pair has moved from 546 pips. You see, it has really made a tremendous move. Now let's use our ruler to do these maths. So that pair moved from that place there up to it moved from that place there up to this place here. So let's see how many pips did it made. 543.50. 543.50 pips. See? So really, that one problem. So look at 543. Let's even say this place here. Yes. So you can see 543. Now the 546 is already 546.78. Sijaweka correctly because our line was started here. But as you can see, it is 540 something pips. So you will meet the first number and now start counting 1, 2, 3, 4. And that is where your pips will start. Okay. Now I'm going to give you an assignment on this. You go and look at the currency called XAU USD. It has 4 numbers before a decimal. It has 4 numbers before we have a decimal. I hope that will be much better. So we'll go back to our slide here. And we are done with pips. And I want now we look at something called lot size. And lot size is a very big determinant in how profitable you are going to be in Forex, in how frustrated you are going to be in Forex. Because if you use a very high lot and your capital is small, it means you will be at a very high risk of even losing your capital in a very short span of time. In a very short span of time. So lot size and lot. So a lot is a contract being made of a certain size. You are making a contract of a certain size. And these sizes are numbers. These sizes are numbers. But there's a standard way where we say one standard lot is equals to a person using a capital of $100,000. So $100,000 of the base currency. So one standard lot is equals to $100,000 of the base currency, and lots are equated also in volume. So we can say one volume is equals to $10,000. And also one thing that we have to know is that one standard lot equals to $10 per pip. That is very key. You have to know that. That one standard lot is equals to $10 per pip. $10 per pip. Very key. And this is where it forms our basic part of this training. One standard lot is equals to $10 per pip. So it will not be depending on the capital that you have. If your capital is $10,000, you can now fine-tune your lot size in such a way that you are going to be risking a certain percentage and expecting a certain return. So let's say if somebody is using 20 lots, 20 standard lots, it will mean this person, for every pip, he will be getting, for every pip, he will be getting $200. For every pip, he'll be getting $200 per pip. $200 per pip, because he's using what? A very big standard lot. So let's assume if this person goes into a trade, he traded that day and he caught 100 pips. What will the profit this person will be getting? We will come and say now, if this person was using a standard lot of 20 lot size, meaning if this person now, he have got 100 pips and he was using 20 lots, it will mean this person, for every pip, he was getting what? For every pip, he was getting $20 per pip. So what about now 100 pips? So he'll come and say now 100 pips times, then multiply now by that multiply now by the $20 per pip, and this person will be making a profit of $20,000 per that single trade. But remember, as much as lot sizing may look good when it is in profit, this vice versa also can happen when it is on loss. So if you are going to use a very high lot size, you must be very, very accurate with what you are doing. You cannot just jump to using a very big lot size and even you don't know the direction the market is going to go. Because if that market goes against you 30 pips, it will mean $200 times 30, and you will be losing almost $6,000 in just seconds or even minutes. So you have to be very, very, very cautious with lot size. If your capital is something less than $100,000, I don't advise using 10 lots and above. If your account is ranging from $10,000, I advise you to use a lot size maximum of 5 and a minimum of at least 0.5. That will make sense. But if you, with your capital of $10,000, you want to run to start using a 20 lot size, you will not last in this market. You will be saying Forex is bad. Oh, Forex is this. Forex is this. Because of what? You failed to follow the rules correctly. Yes. So that is very, very key. You have to really mark that lot size is the big determinant of you being profitable or being not profitable. So now let's look at who trades Forex, and this is where we are going to end this training for today. So we want to look at who trades Forex, and in Forex there are levels of trading in this Forex market. This market is not just there alone being traded by us. No, there are several people that are participant in this market. So in this Forex market, we have, first of all, the people that are on the top part are called the trading bits and the regulating agencies. And when you talk about the trading bits, these are now people that are actually participating in the real exchange of the currencies, in the real exchange of buying these currencies, blah, blah, blah. So when we talk about the trading bit, we have the commercial banks. And these commercial banks now are the banks that will be doing the transaction of these currency pairs. These are the banks that will be exchanging these pairs. You see? And these banks, they are the ones who can be able to manipulate the market. These commercial banks can be able to manipulate the market. Why? This is because they are in contact with the customers. So they are in contact with the customers and they can be able to manipulate the market. They are the ones who know how many people do we have who want to buy this, how many people do we have who want to buy that one. And they can manipulate the price to make profits. You see, the banks are not just there to make losses. They are there with certain targets. People who are working in the banks have targets. Where do you think they are going to meet these targets? It is by doing these calculations. They have to determine, what are we going to get from this? What are we going to get from that one? You see? And that is why now the commercial banks are in trading bits. And I'm not talking about local commercial banks. I'm talking about the international commercial banks that deals with the pairs like the euro, the US dollar, like the Japanese yen and those currencies. Some other currencies are not available in the Forex market so much, which is forecast. So it depends on the currency pair that you are dealing with. If it is the US dollar, you'll be talking about the commercial banks that are in the US. If it will be the euro, you'll be talking about the commercial banks that are in Europe. And if it is the GBP, you'll be talking about the banks that are in the Great Britain. Now, I want to look at the regulating agencies. Which agency regulate this Forex? And the agency number one that regulate this Forex are the central bank. And what do we know about the central bank? Central bank are people who are setting interest rates, on loans, interest rates on land, interest rates on products. They are the one who said this. Taxations, it is being controlled by the central bank. Another thing this central bank can do, they can influence the supply of money. And how are they going to influence the supply of money? The central bank can say, we want to still print another pieces of we want to print 1 million pieces of $100 into the market. Meaning they will be printing how many millions in the market? They will be printing $100 million into the market. And when there is excess supply of money in the market, what will happen? The inflation rate will go up. You see? And when the money supply is low, the inflation rate will go down. Also, if the interest rates are bad or are worse, what will happen? The money in circulation will reduce. And if the interest rates are very good, there is less taxation, there is less this, there is less payee. What will happen is that there will be excess supply of money in the market. And when there is excess supply of money in the market, living standards will go, will be very expensive to be going up. Meaning also it will be affecting the inflation in a negative way, but in a positive way. So it is very, very key to understand the purpose of the central bank in this forex market. There are also other regulating agencies like the IMF, International Monetary Fund, and also they are watching how the countries are behaving, if they are going to be given credits and things like that. So IMF are the part of the regulating agencies. Also now we have under the regulating, under this trading bit and the regulating agencies, we have the hedge funds. When we talk about the hedge funds, these are now the biggest investors in this forex market. These are now the biggest investors in this forex market. And these investors, they take billions of money to these exchange sessions that are in place. And they are also called the big boys. Some people also call them market movers, simply because when they deposited their funds and they say, I want to buy this category of currency, what will happen? Or I want to buy this category of shares. What will happen with those shares? If they are bringing millions of money, those shares will now start attracting other people, and meaning those shares will start going up. So who has set that bullish movement? The hedge funds. So they are called the market movers, or also they are called the trend setters, because they are now the one who are going to set the trend for us. And now we come to us who are being called the investing, or also we are called the speculators, or also we are called the analyzers. These are now people who stay in their computer, in their displays, or in their charts, looking at how the market has moved, looking at how the market has behaved. So we will be accessing the market to see what has the hedge fund done, what has the commercial bank done, what has the regulating agency done. So we'll be looking at to see at what has happened. And for us, the investing, we just access the market through the use of a broker. Thank you so much for joining me today. I will be sharing more and more contents to you. Each day I will be having an opportunity to do so. And I wish you well in your forex trading journey. I hope you are going to learn more as we go along the way. Thank you so much and have a blessed day. Thank you so much.